Hi, I'm Rabil. I'm CEO of Kayne Anderson Capital Advisors and also CEO of Kayne Anderson Real Estate. I've been with Kayne Anderson for 14 and a half years. I co-founded the real estate platform, which currently manages about $13.2 billion of assets under management. Key demand drivers for alternative sectors, and the sectors we focus on primarily are medical office, student housing, and seniors housing, are demographics, plain and simple. So we've got a dramatically aging US population. So with respect to healthcare real estate, medical office, and seniors housing, obviously, you've got dramatically increasing demand. The statistics are actually pretty staggering. We've got roughly 11,000 people every day turning 65 in the US and roughly 4,000 people a day turning 75. So as you can imagine, that not only creates a tremendous amount of demand for housing on the senior side, but on the medical office side, you've got dramatically escalating demand every year for medical procedures and for healthcare. One statistic that I like to cite is that people 65 years and older average seven doctor visits a year, and people under 45 average under 4 doctor visits a year. And so if you just look at those turning 65 every year and kind of run the math, you're looking at 5 years from now about 100 million more doctor visits per annum than we're currently experiencing. And then you can run that out 10 years and 15 years or 20 years. But you've got huge demand drivers in the form of demographics, which is the primary driver. Yeah, so let's focus on medical office first. Medical office is probably the lowest volatility asset class in the real estate world, period, which I know is a pretty big statement, but you look at the sector, which really only exists in the United States, and you've never had below 90.9% occupancy nationally in any year over the last 13 years. And during that same time frame, the sector as a whole has averaged 92% occupancy. There are a myriad of reasons behind this. The basic reasons are dramatically increasing demand and very limited supply. The limited supply is for a number of different reasons. Primary one being that healthcare in the US or medical office was primarily dominated by hospital systems and large healthcare companies until about 10 years ago. And actually still is, the majority of medical office in the US is still owned by hospital systems and healthcare companies. So the reality is that you've got very large, in many cases, bureaucratic institutions that are not reacting swiftly to increasing demand or new construction. You also have a sector that, from a lending perspective, is a relatively nascent sector and not well understood by traditional lenders, including money center banks in many cases. And that's because there weren't real estate loans really being made on medical office until recently. And that's because most of the building being done was being done off of a corporate balance sheet. So I could keep going on listing reasons, but the reality is that you've got a dynamic where, while demand is quite discernible and predictable over the next 10 to 20 years, you don't see a concurrent increase in supply that is keeping up with that demand. And that's quite rare in real estate. Okay. On the seniors housing side, it's been well documented that pre-COVID, there was a significant amount of supply coming online. That has obviously changed dramatically over the last 2 years. And what we now see is the lowest number of new starts in seniors housing that we've seen since Q4 of 2014. What hasn't changed in seniors housing is demand and demographics. And so we are at Kayne Anderson, and this is not unique to us. I think this is very similar across the board. We're now in our 8th straight month of positive net absorption for our seniors housing portfolio, which totals approximately 12,000 units. So we've seen a very sharp snapback in demand and occupancy. And one of the two major publicly traded REITs recently announced that they expected seniors housing rents to increase by 8% in Q1 of 2022. That is in line with what we're seeing as well. So the short story on seniors housing is, while obviously the asset class, and it's a very broad asset class, what I tend to talk about is what we invest in, which is independent living and assisted living. And we only invest in the higher end of the market. So all of the assets that we own are private pay. So we're typically dealing with the wealthier set of Americans as residents within our properties, and we have no exposure to Medicare, Medicaid, or insurance reimbursement. But in terms of what we're seeing on the seniors housing side, while being operationally challenged over the last 18 months, we are seeing a very strong supply-demand imbalance set up for the next 3 to 5 years, and that really just comes down to dramatically escalating demand due somewhat to demographics and dramatically reduced supply, initially due to the dearth of debt availability when COVID hit last March of 2020, but has since been exacerbated by supply chain issues and the cost of raw materials, which have made many previously expected deliveries have either been delayed or fully canceled due to the fact that they're no longer economic based on current cost dynamics. In terms of student housing and what we invest in, Kayne Anderson invests in Class A plus assets, pedestrian to campus at the Power 5 conferences. So these are schools that generally have 50,000 or more students, where we see enduring demand and enrollment growth. What we saw during the pandemic was that even when classes were being offered on a hybrid or even a fully remote basis, despite that, many students wanted a social experience. And so this may be more anecdotal than broad-based, but we brought 2 properties online in August of 2020, one at the University of Florida in Gainesville and one at Rutgers University in New Jersey. And both of those were delivered in late August of 2020. Rutgers was a fully remote learning experience for all of the 2020-2021 academic year, and the University of Florida was a hybrid learning experience. When those properties were delivered, they were mid-90s occupied, leased and occupied, and remained mid-90s leased and occupied for the entirety of the academic year. They then were close to 100% occupied for the current academic year, and we actually sold both of those assets in September of this year. That is an experience that I don't believe was unique to us. While many people expected a dramatic downturn in the student housing market, and the student housing market is a very broad market, I would say specifically with respect to high-end student housing at premier public universities, there was really no downturn at all. There was obviously concern. There were challenges in delivering properties. There were COVID-related dynamics and things that had to be considered. But demand remained as strong or stronger than pre-COVID, and we've seen that carry over to post-COVID. So, in terms of resilience and really being tested, we've seen student housing come through both the GFC and at least higher end student housing come through both the GFC and the most recent pandemic relatively unscathed and in very strong position on a going forward basis. In terms of medical office, I think what we've seen is greater global awareness of how well the asset class performs during difficult times, both the GFC and the pandemic. So the most recent pandemic, I think most people would have had some concerns at a minimum about how medical office would perform, collection rates, defaults, et cetera. What happened in reality was, despite the fact that elective surgeries were prohibited in many states for up to 3 months, or even in some states for longer than that, what we saw in medical office nationally was virtually no defaults, close to 100% collection rates, and really no material changes to the asset class. And so what has come from that is that I think that the interest that was being garnered pre-pandemic by medical office to take one alternative asset class that had started to be recognized as a very interesting place to put some capital for a number of different reasons, but the low volatility nature of the asset class, supply demand imbalance, growing healthcare needs for the next 20 years, healthcare being 20% of US GDP about 5 years from now. All of those things point to a very strong medical office market. But I think the pandemic put the exclamation point on that in terms of taking an event or series of events or a time frame where almost everything that could go wrong went wrong, and you had an asset class that performed incredibly well with virtually no upheaval, virtually no defaults, close to 100% collection rate. So the barrier to entry in medical office remains an operating capability. So part of what we saw 8 years ago or 9 years ago when we started investing in medical office and continue to see today is that there are very few best-in-class, highly scalable operators in the asset class, because it's an asset class that was fully dominated by hospital systems, prior to 2010. And so while it is a $1 trillion plus sector, very large and growing, it nevertheless remains, in some senses, a startup sector, a very nascent sector in terms of investor awareness, in terms of the number of operators that have strong operating capabilities and knowledge within the asset class. So that remains the biggest impediment to large strategic global investment in the asset class. Of course, that's a huge advantage for us because we've got a fully vertically integrated team and an operating partner who has been in the space for 15 years. So we've got a great deal of knowledge and operating expertise. So both relationships and on the ground knowledge that are extremely beneficial in terms of what we can do and how we do it. So it's kind of the virtuous cycle. But medical office it performed beautifully during two global crises. And by the way, and this is true for seniors housing, student housing, and self-storage as well. So call it the alternative sectors in general versus traditional asset classes. I think many investors would give the alternative sectors the nod in terms of being more recession resistant than traditional asset classes, but wouldn't necessarily realize that alternative sectors also dramatically outperformed traditional real estate asset classes from 2010 to 2020. So post GFC and pre-pandemic. So you've got asset classes that have really consistently outperformed the traditional real estate asset classes in both good and bad times. I think it stands out. It stands out where there's a greater contrast and greater recognition when you have a downturn or a global pandemic. But there is virtually no statistic, whether it's year over year same store sales, occupancy growth, net operating income, or any other metric, where you haven't seen significant outperformance by alternative sectors versus traditional real estate asset classes.